Working through the quarter. Let's bring Dan Rohinton, portfolio manager at IA Global Asset Management, on the desk. I want to start with this, and we'll broaden it out to other stocks. The multiple, I mean, I can think of a lot of stocks that trade at much higher multiples that are not so unloved. It's so rare, right, to see this?
It all comes down to just what do you compare TMX Group against? If you compare it against other companies in Canada, the multiple is rich, but Thomson Reuters is 10 turns higher on PE. So there's still room to go. And I think what investors in TMX Group appreciate who hold it today is that data assets in Canada are very scarce, and data assets with growth in Canada, with global growth, are even more scarce. So I think TMX Group has a unique scarcity value in the Canadian market, even though what they announced today, and I apologize, I didn't catch all of the conversation, the US growth that they're talking about in equity trading, I actually think is some of the worst that they could possibly do. But the core asset is incredibly valuable.
And when you talk about the core asset, are you talking about their traditional trading, how we would know about them, and not the move into derivatives or Trayport or data with Verify?
It's actually all of that, except for Verify, and it's 19 times multiple that they paid, and the US cash equities trading, where they think they can offer a unique experience there. I'd say that is some of the most competitive businesses that you can find. But everything else, especially Trayport, especially derivatives clearing, especially the Canadian effective monopoly they have, that's great stuff. So we love most of it. There's just that 10% that we would rather do without.
So you don't own it. What would it take?
Any 10% pullback, we'd be investors today.
And you mentioned Thomson Reuters as the peer, not like, say, the NASDAQ, CBOE, LSC, or, how do you think about owning an exchange operator these days?
So those are all the true comps that they do have. But in the context of Canada, Canadian investors are really choosing between the banks, Fairfax, and the data operators. And there's only two in Canada, which is TMX Group and also Thomson Reuters.
That's right. Okay, I want to take a look at some stocks that we got earnings from today. Eli Lilly is super fascinating. You want to talk multiples? Let's talk multiples on Eli Lilly. Do you own this one?
We don't, but at the same time, we can have respect for a business that's going through genuine innovation and exponential growth, and that's exactly what the trizepatide Mounjaro business has been doing. So there's years of that growth ahead. The debate for Eli Lilly investors, which is why it trades at almost a 400% premium to big mega caps like a Pfizer, is that investors are pricing in not just today's growth, but 4x the growth in the core franchises that they have. So this is a very unique asset along with Novo Nordisk in the global landscape, and they are by far the best pharma growth assets that we have in the world.
So are you waiting for a pullback, or did you take profits?
The debate on this is really, what do you think the ultimate patient count is? So we don't have confidence that the 500% growth that we need to see in earnings for the multiple to make more sense long term. We're not confident around what that end state could look like. So it's really just about taking in more information today for us.
And I mentioned we might be seeing a little bit of a rotation. Take your chips off of a stock that's doubled over the past year and put it into some laggards like BMY and Pfizer.
I would generally say we want to stick with the innovative companies in the pharma landscape. So Pfizer's been around the same market cap and valuation for the better part of 25 years now, because there's always a generic wall hitting. So I do think
that's going to come for Eli, isn't it?
What's unique about Eli Lilly and Novo in a pairing, because you have to think of them together, they've evergreened the assets, and they're very specifically focused in these areas. So I do think what they have is unique and doesn't have the same patent cliffs that the others would. But that's always a risk to worry about with these companies.
What are you doing with your tech exposure these days now that we are through the bulk of the magnificent earnings?
So overall, it was a great set of earnings, especially for a company like Meta Platforms. So we actually added some to our positions there. But on balance, we've been selling into some of the strength in especially a very concentrated set of tech stocks.
You added to Meta, even with its, it was like a 20% move on one day. You felt comfortable with that?
So normally we don't buy on big strengths like that. But when you recognize that the fundamentals were even stronger, where earnings revisions went up almost 30%, a 20% stock move, even though it's higher, the stock actually got cheaper. And the more important thing to really drill into this on Amber is the actual fundamentals of how they grew revenue, brought costs down at the same time, and led to an explosion of free cash flow, which for the first time, and I didn't think I'd be saying this about Mark Zuckerberg, he actually recycled it into full-on buybacks, and introducing a dividend.
Yeah.
That's a management maturity that's been a long time coming at Meta, and that's why it deserves to trade at a bigger premium, synonymous with how Apple went through its transition in the early days of Tim Cook.
So the stock and Mark Zuckerberg, they're kind of growing up in front of our eyes.
Absolutely.
Are you worried that hobbies, let's call them that, spending on, different little projects, which really spooked investors a couple of years ago? I mean, that's kind of still going on.
Yeah, and it's actually getting more expensive.
It's getting more expensive.
It's more expensive
yeah.
hobbies. But what I would leave you with is that's already something investors know, that these pet projects, the same way Google's other bets segment is a profit drag, you basically price that into the forward models. And historically, they haven't really accelerated much more above trend. So we price in those dynamics. All I could say is Google without other bets and Meta without its reality labs would be worth significantly more if we just took that cash burn away.
However, then they risk not having that next thing, right?
That's right.
Do you have to kind of accept that? Just generally fully invested, getting a little nervous, what are you doing?
Raising cash at the margin, but more redeploying in different areas. So this is the year for diversification, and I still believe that.